Our second speaker is Hao, who is the Director of Australian Finance House, and Hao has accumulated over a decade of experience in the finance industry. Hao is always looking to provide ways to provide the best financial solutions for his clients. Unlike most brokers who focus on advertising the lowest interest rates, Hao understands that each individual circumstances is different, and sometimes a loan with the lowest interest rate may end up being the most expensive. Hao was nominated as the Young Broker of the Year during his first year of business, and this is a testament to his expertise and professionalism. Hao specialises in both residential and commercial finance, with successes in securing finance in first-time developers. Please welcome Hao.
My name is Hao. Just a bit on my credential. I used to work for HSBC for 6 years as a relationship manager in private banking, and I have started my own business 3 years ago. Like Vicky has said, I was nominated as the Young Broker of the Year in my first year of business. In my second year of business, I won the award for in Better Business Award, and in my third year, I was nominated as the finalist, national finalist in the MFA Excellence Award. So if you think all brokers are the same, they're not the same. Okay, today I'm going to touch on a quick topic on the power of your equity. Many people would just hang on to their property. They buy their own home and they hang on to it for the next 30 years. They pay off their loan in the next 30 years. I'm not saying that is bad, but think about what you can do with the equity in your property. Think what we call rolling money, building your wealth with your property. Okay, I'm going to give you an illustration, 4 examples of 4 local Aussie blokes. Okay, one's Aaron, one's Brad, one's Charles, and one's David. They're all the same. They all have 130,000 in deposit. They're all 30 years old. So I'll tell you the main difference of them. Aaron, he is a typical homeowner. Brad, he's a typical casual investor. And Charles, if you look at him sitting on a chair, he looks like a boss. He's a savvy investor. And David, let's not talk about him now. Okay, for Aaron. If you look at Aaron, he's got 130,000 deposit. He looked at buying a property for 500,000. With the 130,000 deposit, that's sufficient to pay for 20% of his purchase, plus the stamp duty and other charges. And assuming property grow at a 5% rate, if you all are following the Sydney market, over the last 4 quarters, property grow by 12.12%. This is released by ABS, Australian Bureau of Statistics. So property growth by 12.12% over the last year, but we're just assuming a 5% growth per year. And after 20 years, his $500,000 purchase will be worth 1.3 million. So his total asset value after 20 years will be 1.3. And this is Brad. Brad is our typical casual investor. He's got a 500,000 purchase on day 1, same as Aaron. Assuming a property growth by 5% per annum, in the 6th year, he would have sufficient equity to take up another 130,000, which is equivalent to 20% deposit of a $500,000 purchase and the stamp duty. And using that money, he purchased another property worth 500,000. And his total value of his home, together with his investment property, is worth over 2.2 million after 20 years. So this is how you grow money with your equity. And the third one, Charles, he is being smart. He uses his property to invest in more properties. Over the life of the loan, over the life of the 20 years, he uses his property, he revalue his property constantly and revalue his property and gain assets and gain equity out of the property for the purchase. But in the ninth year, he'll be able to purchase his second investment property for 500,000. This is using the equity from his first home and his first investment purchase. So by the end of 30 years, his home will be worth 1.3 million. His first investment property, 940,000, and his second investment property will be worth around 815,000. So his total worth after 20 years would be close to 3 million. And last one, it's David, our poor David. I hope no one's named David in this room. Okay, David, he loves his family. He loves his parents. He decides to stay home with his parents. Use his 130,000 deposit, place it into a term deposit. The term deposit, assuming a 5% return per annum, and we all know in current market, your term deposit, at best you get 1.5% return. Let's say he puts it in for 5% per annum, and for the next 20 years, his deposit will be worth just under 700,000. And if you compare that with the first three examples, putting money in a term deposit would not grow your money. If you put for the 130,000, if you place it in a term deposit for 20 years at 5%, your actual value after 20 years is 350,000. But if you continually put in 10,000 per annum into the term deposit, what you'll end up with is close to 700,000. So regardless what you do, property will grow at a faster rate than term deposit, and term deposit doesn't include inflation as well. And finally, if you look at the illustration, who do you want to be? Do you want to be Aaron, or do you want to be Brad, or do you want to be Charles? Who do you want to be? Or you want to be David? Okay. And finally, just a few words before I finish up my presentation. As Ivan has said earlier, in a booming market and a seller's market, it is important to act fast. You need to move fast. And the main thing, one of the main risks is finance approval. It is important to get your finance approved, getting a pre-approval from the bank for the investment purchase. The other thing is getting your money ready. If you're looking to buy an investment property, you do not have sufficient funds on hand, you might want to revalue your property and get equity out from your property. It is best to do the revaluation of your property and getting the equity out before you start looking for property. So that gives you the additional time to produce the 10% check to the agent and close the purchase as soon as you can. And finally, like Ivan said, there is a disclaimer. This is only for general advice. Everyone's situation is not the same. It is best to speak to me individually, and I can talk to you about how you should structure your loan, how you should get your finance approved with different lenders. And now, thank you very much, and I hope to speak to everyone later on. Thank you.